Hello everyone, welcome to your podcast. Thank you for choosing MYCPE as your partner for continuing education.
To avail your credit certificate, it is required for you to complete the entire video. Please do not fast forward the video. Otherwise, the system won't be able to capture your watch time. If you cannot go through the entire video in one go, you can always come back later and pick up from where you left off. Please note that you must answer all the review questions correctly. To access the final quiz, you'll need to watch the entire video. A minimum score of 70% on the final quiz is required to earn your certificate. The handout material is available for download in the designated section. If you have any technical questions, feel free to email us at support@mycpe.com.
Happy learning and thank you for choosing MYCPE. Let's get started.
Welcome to the Concierge CPA podcast. I'm your host, Dr. Jackie Meyer, CPA. I have Van Carlson with me today. He is the founder and CEO of SRA 831B, which might sound like a very confusing thing if you don't know what an 831B is. So Van, welcome. I'm so glad to have you finally. And tell us a little bit more about you and what is this company all about?
Yeah, no, thanks for having me on your podcast. I appreciate it. And so really it's risk management. It's an exciting part of your business, right? An entrepreneur is always worried about risk management, right? So, but that's really what we do. We focus on risk management in a way that makes it, we like to think of we embolden business owners through innovation of risk management. And so what does that mean? Well, we've got a lot of risks to run our businesses today, and it's not getting any easier. When we talk about 831B specifically, it was a part of the tax code, and it was introduced in 1986 Tax Reform Act, and it really was designed to recognize self-insuring risk, and Congress deciding, hey, if your business owners are going to self-insure risk, do we want them to use pre-tax dollars or after-tax dollars? Mm-hmm. And if you're gonna want to use pre-tax dollars, then you're going to have to elect under the 831B tax code. You're going to have an administrator administrate it, no different than the 401k is done as well, right? Any kind of tax code, any tax incentives out there, you're going to want a third-party administrator to help administer that plan. And that's where we come in as 831B administrator. And that's really it. I mean, it's just utilizing a tax code that it's a complicated issue when it comes to risk management, honestly. And I'm sure we're going to get into some of those issues. But when you look at the marketplace we're in today, I'm one of those geeks that like to read periodicals about risk, and I will tell you that the world has gotten much more complicated since 1986. I can tell you why the code came into existence in 1986 was due to mostly crop insurance and a lot of liability claims. We didn't have the tort reform we have now. It's different state levels. And then now, obviously, crop insurance today is federally backed by the federal government. When it comes to complication of risk, though, almost 40 years later, we've got supply chain risks, we've got brand protection issues, we got dispute resolutions, we got cyber issues. I mean, it's so much more than we had back in 1986, and a lot of it has to do with the age of technology, the age of information we're in today. But so the world's got much more complicated. And we're busy. I mean, honestly, the marketplace is kind of driving that. People are paying for more in premiums, but they're receiving less in coverage. And that just puts more burden on the business owners. And honestly, Jack, I don't see that it's going to get worse before it gets better, unfortunately.
Mm-hmm. Yeah, I could definitely see that. So for someone that still has no idea what an 831B is, I can give it in layman terms and then you can correct me. But essentially, you're creating your own insurance company to self-insure unique liabilities or risks that are involved, right? And the street term for that tends to be a captive insurance. Now, there's a lot of negative connotations around the word captive insurance because the IRS has been targeting it somewhat, so to speak. So would love to hear your perspective on where all that stands now.
Yeah, it's always I'm a risk manager, so I'm always got to hedge that side of the risk, right? So, unfortunately, back in 2000, a lot of the concept of so an 831B, to your point, is a sole and separate company. It's a C corp, and we help minister that for the operating company's owners or the operating company itself that we're working with. And we work with a lot of different industries across the country. So we go in and do the underwriting, we do the process, but the box that we're going to build has to look and feel like an insurance company. Again, we as administrator, we make sure it adheres to the 4-part test and all those things.
Mm-hmm.
Most of our competitors out there, I would say, are law firms and CPA firms. And the law firm guys really went out and sold it more as an estate tax play. And it's getting back to that 2000 through 2010. When you look at the court cases the IRS has targeted due to bad facts mostly, the motivation was not risk management. The motivation was estate taxes. And so that's where the pressure came from. Honestly, I think I think the IRS themselves have come out and said that there's legitimate reasons why you'd want to have an 831B.
Sure.
And it's probably more so than ever before. We've gone through our promoter audit, 6,700 promoter audit as a promoter of this tax code. If any tax code, if you're successful at it, eventually the IRS is going to come knocking, and it is what it is. It's nothing to be afraid of or scared of if you're doing things right. And I will tell you, we started that process in August of 22. We got our letter last year, July of 24. They've shut down our audit with no changes. Now,
nice.
Of course, they don't read anything into that. But unfortunately, there's still now. I will also tell you that 2017, under the PATH Act, there became some ownership testing you have to do now to avoid the estate tax play. So that's also brought the pressure down. But I also will tell you in that same turn that they increased the amount you can contribute. When you first started this, you could put up to $1.2 million a year. Back in 17, they added another $1 million that you can catch. So that's per year. Okay. That stays tax deferred inside the C Corp. I guess we should mention that. I always forget to mention that part because that's obviously the important part of this.
If you don't mind, let me decompress that a little bit. Or dissect that a little bit. So this is like $1 million premium. That's an ordinary deduction to the business that's making it. And then the insurance company C Corp does not recognize it as income because it's insurance proceeds, so to speak, right?
And that's the whole purpose of electing an 831B. So as long as you elect an 831B and you stay below this year it's 2.85 million, for example. So they had a CPI rider put on it. So as long as you stay below that, you can elect under the 831B and keep the premium. It's income, but it's not taxable income. The only thing that would be taxed inside that C Corp would be any realized investment gain. So let's say you put the $1 million into a money market account and you got 5%. Mm-hmm. You would pay $50,000 in at the corporate rate, which is currently 21% on that $50,000. So that's the only thing it's taxed on. Why it's ceding risk, why it's operating like an insurance company. It's just realized investment gains is what it's paying taxes on. It will not pay taxes on the premium itself.
Sure.
And that's obviously a big advantage, right? I mean, now you're able to build up surpluses, you're able to take on more risk. I mean, because when we assess business owners, I mean, there's some risk in there. I mean, it can take 3 to 5 years to build up before, just on deductibles alone that business owners are taking on today, just to offset their cost or what they're being forced to take on when it comes to coverage, especially when it comes to property values today. It's of anything out there right now, property is the biggest pressure. And we've not even priced in the fires yet from LA. So 2025 is going to be it's going to be an interesting year on that front again, unfortunately.
Yeah, for sure. So speaking of that, what are kind of the main contenders of what people are insuring their risk against? I mean, obviously there's a whole new realm with COVID, the wildfires, et cetera, that people just never thought would happen. Is there consistency across the board of what people insure through these captives, or is it very unique to every business?
I would say that for the most part, most businesses have the same issues. I mean, right now, when you look at supply chain risk, brand protection, we call them enterprise risk management. These are risks that insurance companies will never offer coverage for. Mm-hmm. And you're basically self-insuring.
That really honestly scares the hell out of us the most, right? It's scary stuff. Yeah.
Yeah. And, on top of all the, cyber today has got a lot of stress on it. I mean, you are getting a policy right now. If you got a standalone policy from a company like Beasley, which is Lloyd's of London company, they're going to do the credit watch and all that stuff. But when you look at all the sublimits, unfortunately, it's just not going to be a lot there for you. And then
There's
you got
a
to
lot
take,
of clauses and disclaimers around
oh
things
man,
they can and won't do if you have a cyber risk. It's really crazy, right?
it really is. And I deal with a lot of cyber folks around the country, a lot of forensic folks that will go in there forensically, find out what happened, what transpired. And I had one gentleman a couple months ago tell me, Van, it's been 18 months since I've seen an insurance policy trigger coverage for his bill,
Wow.
where normally like a lot of these policies would pay for a forensic team to come in. And, if you were phished, or let's say you were locked out of your CRM system, or all
Mhm.
that, you want to make sure those people are completely out of your system. And that alone, you're taking on your own now. Insurance companies don't want to pay for that stuff. So it's gotten really it's, again, we can have a whole other conversation about cyber today, but I would tell you that, a lot of them are common. And then the other thing is you bring up a great point. I mean, the more niche you are in whatever industry, let's say you carved out your own industry, or your own product, or you're a unique business. The problem sometimes with that is the insurance company has the one glove fits all. So they're going to try to find a square peg to put you in with a round hole, right?
Mhm.
So the problem is the more unique you are as a business, and they're trying to classify you in a way, you're opening yourself up to more exclusions and really coverage that may not pertain to you, that you
Mhm.
really would really need. And that's where we come in. I'd tell you that we have one of the most robust risk management teams, and we don't charge for that. I mean, we just bring it in. We do assessments. We try to keep the conflicts of interest out wherever we can find them. But honestly, I think in today's world, as if anything, your listeners, the risks that we've all taken to get where we're at as business owners, they're, taking an idea, ran with it, making a profitable company. And now you're looking on the backside of this thing. I think risk is paramount as part of it's part of the things that you should be looking at every quarter, every day, every week, and having plans in place. You brought up COVID-19. I think one of the reasons why we've had success in the last couple of years, more so than normal, is due to the fact that business owners are now looking at themselves like, yeah, I get these policies, but they're not covering me for everything I need. And
Mhm.
honestly, we're having conversations with business owners, Jackie, that says, listen, if you relied on PPP or ERC and these things to keep your business afloat, what are you doing different today? And if you're not doing something different today, are you really going to expect the government, God forbid, if that was to happen again, to step in and help you out again? I don't know. And so that's getting a lot more traction with business owners today. Just the idea of that.
Yeah. So a lot of people think that this is, well, just like any more kind of advanced strategy, it's for these bigger corporations or bigger businesses. But what is kind of the threshold of a business owner that would utilize this strategy? Is it based on kind of the amount of premiums that they could start putting into a company?
Yeah, we look at the gross revenues, just like every other insurance companies. We're going to assess their gross values. Gross revenues. From that standpoint, that question used to be more easier defined. I
Hmm.
started our company in '08, and I did it because of what was happening with the Great Recession, where business owners, there had to be a better way to manage their financial risk than just relying on the 172 and keep betting every year was going to be better than the previous year, right? So
Mhm.
that's why I got into it. And then 16 years later, whatever it is now, when we first it was like $100,000 minimum. We structured our fees in a way, because that's also, I would tell you, a lot of times when we deal with business owners around the country, they've either looked at these in the past and they were fairly cost prohibitive.
Sure.
To your point, I would tell you too that, just like anything else, as more and more people come into the space, you're going to see fees compress, competition starts to take in. And that's kind of where we're at today. I would tell you, we have probably, I see new names creeping up all the time into our business, which I'm good with, honestly. I think this needs to become a normal business practice. We need to take the boogeyman away from it. And every successful enterprise out there ought to be at least looking at this, or at least be aware of this, or working with CPAs and tax planners to
Mhm.
say, hey, is this the time to look at this? Is this a good fit for you? And you got to take the fees in consideration and all that stuff, obviously. But I would tell you that if you can at least do $100,000 a year, but even then, it's kind of it's such a moving target. It's hard to. I would tell you, there's no enterprise no industry we don't work with, and I
Okay.
think, if you've been in business long enough, when I was selling traditional insurance, I would tell you at least 40% of the time I was telling a business owner it's not going to be covered. And here's why. So if you're in business long enough, unfortunately, you're going to have these experiences. And then it's just like, well, what do I do now? And it comes back to the cash flow. That's why PPP and the government had to step in under COVID was they couldn't afford to lose your operating capital. You lost your operating capital, you could, okay, well, we can open up a year later, but meanwhile, you had no operating capital. So what are you going to do, right? So those are things that I just tell business owners all the time. It's like if you can use tax deferred dollars, set it aside, you utilize versus trying to use after tax dollars. It's just an much more efficient way of running your business. And to your point, big companies have been doing this the longest, and you got to compete with them. And these are the types of tools that they're utilizing to give themselves a competitive edge too.
Okay. So let's talk about kind of recent IRS regulations and developments. So the IRS, the last thing I heard, which, there's so many different things going on, was that there were proposed regulations to identify certain micro captive transactions as listed transactions. But other types of captives are not listed transactions anymore. Is that right?
It's, there's a lot of confusion there. And
okay.
We work heavily into that arena. We work with our lobbyist group in DC, and we can actually, there's a lot of good things going on under this code. So I think the week before the last administration was leave office, they actually came out and made those proposed regulations. And really it comes down to a transaction of interest or a listed transaction. And it has to do with a 10-year span. If you become a listed transaction, mostly if you borrowed money out of your 831B plan, we do allow that to happen. It's been held up in court that those are all legitimate loans. I think the IRS looks at those as additional abuses potentially. However, it should be noted that you can borrow from your 401k too to make a first-time home purchase, right? So business owners have been utilizing these types of tools for a long time. Again, getting back to the big Fortune 500 companies, large privately held companies, they've been doing this the longest. And I know they borrow all their surplus out of their insurance companies, right? So they know how to leverage better than most business owners, when you're that large, but they're not afraid of the IRS either, honestly. Their CPA firms are Deloitte and KPMG and, all that good stuff. But what we're trying to deal with is the small to middle market business owners is predominantly who our clients are. And yeah, when we work with CPAs around here and they get, the IRS gets brought up. And of course, I would tell you the IRS is really good at propaganda and scare tactics. Sure. However, I would just tell business owners all the time, if you're coming in here with the sole purpose of a tax avoidance, I would sleep uneasy. If you're coming in here because you have real risk management issues and you're self-insuring risk and you want to take advantage of the tax code, that's a whole nother level. And that's really where we're at today, Jackie. It's not, obviously it's a tax incentive. Congress can motivate the American people and in all sorts of ways. And I will tell you, utilizing tax incentives is one way they do it, right? We all know that. Sure. They're not, from that perspective, they know what they're doing. And I would tell you that, again, it comes back to what was the purpose, what was the motivation of doing this? And so we've never had business owners get audited due to an 831B tax code. We've had clients get audited just due to their operating companies, and that comes up. Of course, we come into conversation on that, but we haven't had changes. And we've been doing this the longest time. We've been, like I said earlier, we've been through the 6700 audit. We have continued to, I think we've done really well on administration, and we're the largest manager of these plans in the country. We have about 150 advisors around the country. It represents our products. We work with a lot of tax planners. I think this is a great tool for a lot of business owners today, more so than ever. And it's what's really driving the bus, not only the enterprise risk management I was talking about, but really what's happening in the traditional insurance again, where, the burden is falling more and more to the client, the business owner. And so we're getting a lot of traction on that front. I will tell you this, I think the long-term story here is we're going to get some clarity in the code. When those things, I do think it's going to become a normal business practice. And there's tax incentives aside, great, but it's really coming down to risk. Insurance companies are not going to continue to increase their risk for appetite risk. They're just not. If anything, they're going to continue. The exclusions and all that stuff that's going to be coming in the back room is just going to continue. And I get it. It's like the banks. They got to be careful, but they're going to be a run on the banks. It's going to be careful. They got to have a run on an insurance company. And right now, they're trying to limit their exposures wherever they can, and we'll continue to see that happening. And the reinsurance markets are under stress right now, so it's going to be a more complicated issue. And like I said, it's going to become a normal business practice. I think we got some great traction with the current administration, some of the congressional leaders. We're trying to get some things defined in the code, but I really feel within the next year to 2 years, it's gonna become more awareness. And that's one thing I appreciate being on your platform. And we're in an education process right now, because even though code's been around for 40 years, to this day, I'll still run in the CPAs and I'll still run in the business owners that have never heard it.
Right.
And,
yeah. It's pretty
so,
crazy, right?
Yeah. But
okay, so I found the final IRS regs. It looks like they were effective January 14th, 2025. And so that was narrowing the scope so that only micro captive transactions that meet both the financing and loss ratio tests are deemed listed transactions, while similar things or other captives, I guess in general, are transactions of interest instead. Is that correct?
yeah. And
okay,
so
cool.
Yeah. And so some like the automotive ones are exempt from it. I think they have a really good lobbyist group, obviously. But the automotive guys have been doing this for the longest. They've been doing this before the code even came into existence. And it has to do with their service contracts and selling a third-party warranty. Most of them have brought it all in-house, but and they utilize an 831B tax code with that. But so there's some of that stuff going on. Then the macro captives, where you've replaced traditional insurances altogether. And obviously these are large companies. The IRS had targeted those back in the 90s. They sued, I can't tell you how many times they sued UPS, but eventually they kind of capitulated on all the macro, they call them macro captives. And that's also been something that's been kind of set aside on it. So we're not too worried about these regulations. I mean, we've been filing the 8886 documents, which is a transaction of interest that, since 2016. We've not stopped doing that, even though a couple years ago, it was questionable whether or not we still needed to file that.
Sure. And I appreciated that. I didn't actually really ever feel comfortable with captives until I came across your company in particular several years ago, because you do that extra due diligence and you are recommending that people still file XYZ just to be conservative if there's an unknown, right?
Yeah. If you got nothing to hide, then it's just more paper. I mean,
right. And where does the paper go? No one knows, right?
There's always a debate on that. It's like, well, how long do you think it took them to open up the envelope? But
right.
So that's what part of our administrative fees is to do the tax return for these C corps as well, right? So
okay,
and so we send out, like I think we're going to do like almost 800 tax returns this year, and we send out individual envelopes because you can't e-file those. They have to send 1120 PC tax returns have to be paper filed.
Okay.
And I've been told I'd love to put an air tag in one of them, but I was told do not do that. I
love that.
Well, would anybody's curious to know? I would anyway. So we won't do that.
Watch it like end up in some fire dumpster, right? In the back of like some random
run out of battery sitting in, I've been told that they all get shipped to Ogden, and I've been told that there's like trailers sitting out back in their parking lot that have boxes and boxes of Well,
I just saw yesterday the IRS is investing about $8 million in some NVIDIA AI hardware technology. So we'll see if that gets them all caught up on all this stuff, right?
You know what? Honestly, if they just got rid of 12 of their different computer systems, I mean, that alone would be a huge, honestly. I mean,
for sure.
Anyway, it's just, we'll see where that whole industry goes. I find it fairly intriguing to watch. I mean, we live in exciting times right now, whether for better or worse. You can't admit that there's dull times right now. It's we'll
For
see how it all
sure.
plays out.
There's a
Technology's a
lot
big one.
a lot of modernization that hopefully we will actually see in the next several years. So I'm with you. I think it is an interesting time where we might see some improvements. Okay, so real fast, so let's redefine, just in case people don't know, what is the difference between a listed transaction and a transaction of interest?
Transaction of interest is just, I think it's a buyer beware, honestly. And this is coming from attorneys I've talked to that worked for the IRS at one point. And a lot of times when they're requiring these type additional documents, it's a way for the taxpayer to take a pause. Do we
Okay.
want to do this or not? Right. I mean, and honestly, again, I'm okay with that. Honestly, I get it. I think, unfortunately, we have bad actors in any industry, and we do have bad actors in my industry. I mean, it's just the way the world works.
Sure.
So I'm okay with that with additional documents. The listed transactions, I'm a little bit more hesitant to agree upon, and it gets into the point where some CPA firms won't even do it because it is a listed transaction. So it just becomes more of a basically, the IRS says you are in a tax shelter, and it's kind of like guilt before, guilty without being found guilty of something.
Sure.
Because you can still be doing it perfectly fine. I mean, there's been listed transactions all the time. I think conservation easements just recently obviously got on that list. And again, these are legitimate tax codes done for legitimate reasons. Does the IRS like them? No. So they put these additional requirements on them. I will tell you, with the current administration, we are getting some traction on to quash the whole thing, honestly. We think it's, again, because of the Chevron case that came out last year, we just feel like they're putting additional regulations on a code that the bureaucracies don't get to do anymore. And that's one of the things that we're kind of forcing with our lobbyist group called MYCPE. There's a lot of us out here saying, hey, and we're just not the only ones, right? I mean, it's across the board in different bureaucracies where they have added more regulations to an existing law. And of course, due to the Chevron case overturning last year, that's one of the things that they don't get to do anymore. If they want to change the law or add more regulations, so they should go to Congress and run those through Congress and not necessarily take it upon themselves. We can make an argument for a lot of things over the last several decades that have transpired since the 1984 ruling from the Supreme Court, where the Supreme Court ruled that basically the bureaucracies enforcing federal law, the assumption is they're enforcing it the way Congress has intended. And that's, if you look over the last several decades, obviously the bureaucratic state, I shouldn't say it, I don't want to get too political. The bureaucracies have become much more powerful over the last couple decades due to that one ruling. And the fact they got overturned last year, I think, has also opened the door for us to challenge certain situations. And like I said, I think you're seeing that not just with the IRS, but you're seeing that across EPAs, any BLM putting additional regulations, all the stuff that goes on out there that's basically they've added to the law where that was not the intent of Congress, or if it was to be added, it should have been done by Congress. So these are some interesting issues, again, going on in the world that we're looking at. And we're encouraged by what some of the things that we're hearing and doing right now to quash the whole thing. Whether it gets done or not, to us, we're going to keep going forward. If you get into a listed transaction, which obviously the IRS is going to look at that more seriously, is what I'm told, than a transaction of interest. Okay. Now, on top of that, though, I would tell you that, again, it's about your consciousness. What are you doing this for? And if you're doing it for risk management, even if you are in a listed transaction, I think it's still, if you're doing it for the right reasons, I think you can still sleep easy at night. Will the IRS like them? And here's what's the other goofy thing about these are C corps. And the IRS really doesn't know who owns these things, because I was talking about their software earlier, the computers. A C corp is typically a publicly traded company. You'd have to know all the shareholders. They don't. Their system's not set up that way. A C corp is, as you know, is its own person essentially. And so I think that's another reason why they want this information. They just want to know who owns these things. And sure. I'm okay with that, honestly. So.
Yeah, that makes sense. Okay, I want to walk through kind of the timeline of starting a captive, and then, when you might need to use the proceeds or not, and what happens on the back end, kind of the tax situation that happens throughout that life cycle. Before we do that, I do want to comment on a few things you just said. I think you have I guess it's a blessing on your side that this is tax code since 1986, because we are in kind of unparamount times where there's new tax strategies coming out yesterday, a year ago, et cetera, that have no tax code support whatsoever. And we're just trying to kind of like wade our way through it. In fact, my next podcast interview is with the CEO of a company called Nepsis, which does what's called the tribal tax credit, which has no tax code support whatsoever. And so that's going to be a real crazy deep dive. But you do have years under your belt of experience here, and you've seen the ebbs and flow of the administration. Another important thing with the current administration is you mentioned conservation easements. We know that our current president himself actually invested in those. So we have a more aggressive administration, more pro-business owner, right? And so it will be really interesting to see how that all pans out. Any final thoughts on that side of things before we move to our timeline?
No, that's a great point. I would also tell you that he also, the current the current president also participated in captives.
Okay, I was going to say, I'm sure there were probably a ton of captives too. I don't know.
if you're in construction business, building those kind of buildings, you're definitely going to have captives. But
okay.
So yeah, you're absolutely right. I would also say that, and you know what? It's so funny. I'm so glad you brought that up, because the IRS won these cases, and they, it is there's legal precedence now, right? And the legal precedence is telling you what not to do. And
Sure.
so honestly, we took that and we designed our program on some of the cases they won. Like, we don't play games with who owns these things. If the operating company can own it, or the owners of the operating company will own the 831B plan. We don't let trust own it. We don't get cute with that. And I think and we don't sell life insurance inside of these things, because that's another big thing the IRS doesn't like, which is understandable. You're using tax deferred dollars to pay for a life insurance policy, and the proceeds become tax free. Guess what that starts to sound like? Tax free income, right?
Right.
So, and I don't promote that, right? It's like, I don't plan to live here forever. I want to live a long time, but I know I'm not going to live forever. So, death and taxes is going to happen. So we don't promote that stuff. But my whole point is I think the legal precedents that the IRS loves is, look at all these bad, and of course they cherry pick bad facts, and there's been some really bad facts out there. I mean, and it's not been due to the motivation risk management. And so, again, I think, okay, now we know, okay, we shouldn't do that. Let's go do this, and to your point, I think the legal precedents, we got legal opinions. I would tell you, we got some of the most robust legal teams around the country. They've all got a couple of them that have won these cases, have gone in their own private practice when they worked for the IRS under the chief counsel as an attorney, and we hire those guys. And so all of that stuff obviously helped with our 6,700 promoter audit. I'm told by that group that we're probably the only ones that they know of that ever got that letter. The IRS didn't have to even send us that letter. They could have just went away, and that's the prerogative they get. I think we spent almost $250,000 to comply with, to completely cooperate with the IRS on that. And I'm just glad they sent us a letter. So, but yeah, I do think it's, we run into new tax stuff all the time too. And I'm always kind of like, really? That's what's going on out there now? So it's an interesting game. I mean, it is.
Yeah. But I guess, I'm in an interesting position because I have a tax advisory SaaS software where we recommend all these strategies, right? And so what we're coming under right now and figuring out is, what is our responsibility in presenting these new ideas and strategies and concepts to tax advisors? And then what kind of due diligence do they need to do on their own? So I'm curious what your perspective is on that, because you've been dealing with this for many, many years. You have, I'm sure, you said many accountants have never even heard of captives, which is nuts, but a lot of them aren't going to do them because they've saw one bad article about a bad player, right? So how do you address those kinds of like irrational concerns, or people trying to kind of group, what you do in with one bad player on the market?
Yeah, it's a challenge. I would say this, and it's really, I've gotten CPA, I've gotten to the point where business owners have said, hey, I've had, I'm just going to change CPAs. I mean, and God bless, it's a compliance public accountant, I call them. I mean, these are people that are not, when I hear business owners saying they're doing tax planning in December, when I hear that, and I can't remember the guy's the battle's been fought.
Hmm.
They're coming to give you the wound and the dead report. They're coming to tell you what you need to pay. That's not tax planning, right? So
Right.
I love the fact that we've seen organizations like yours and other ones kind of get some steam out there, because honestly, these business owners need true tax planners, not somebody that's putting numbers in the right boxes in the tax form and trying to get as many tax returns as they can done in 2 weeks, right?
Mm-hmm.
I mean, those days, talking about the AI and everything, I think those guys they're on the way out. I mean, I'd say in 10 years from now, if you focused on putting numbers in boxes and that's been your big tax plan, I think those guys' days are numbered, and I think some of them know it. But outside of that, though, these people are used to, they're just trying to, they just are constantly up against a deadline. They don't know anything about the 831B, and I never want a CPA to look stupid in front of their client. So we always will try to take a little bit of time with that CPA. I'm always amazed when they don't know about it, because I'm like, man, don't you just at least read the propaganda coming from the IRS? You at least hear a little bit. But anyway, so how engaged are they, right? That's kind of my thought in my back head. And a lot of business owners just simply outgrow their CPAs, but out of loyalty, they stay with them, and they don't have the personnel, the manpower to really engage in tax planning. And it's unfortunate, but I would tell you that I've had some really tough conversations, where, I get it. I wouldn't want to be a CPA, honestly, trying to do tax returns. It's
a
not
lot.
It doesn't seem to be fun, honestly.
No. I agree. That's why I went from traditional compliance firm myself to leading with tax advisory, and it is fun. So I love that.
Solutions to real problems, and you're like,
yeah,
even if they don't do it, at least you brought something, like this. This is just another tool in a toolbox for you guys. For the right client, it's a great tool, but it's not for everybody by no means. But just bringing solutions like that to the risk takers we have in our communities and our country is just a huge deal to me. And that's probably one of the most rewarding things we get. And I'm sure it's rewarding for you too. I mean, it takes a lot to get to where you're at, like to turn your business into a taxable, highly taxable taxed entity is not easy. Now,
sure.
How do you minimize that too? Anyway, so the CPAs are always our biggest challenge, although I will tell you, they're our biggest referral source too. So we work with them, but honestly, I tell business owners, I think your CPA doesn't lose sleep when you pay taxes, and if you didn't pay taxes, I think he would lose sleep. And so, what's his interest in is he have your best interest at heart? And the other thing I've really heard from CPAs, I really thought was really smart, and I kind of bring this up with the business owners, is you're a risk guy. You take risk every day, and you calculate, and you try to do the best, but you're not afraid.
Mm-hmm.
If you're a CPA, nothing against CPAs, but naturally this conservative. And when I heard a CPA tell me one time, he goes, "Dan, the problem in our industry, we apply our risk tolerance to our client instead of looking at the risk tolerance of our client and addressing our risk tolerance to them." And I always thought that was interesting. From a financial standpoint, you couldn't do that, right? Like, if I was like, hey, I bet it on red all the time, I couldn't take my client's money and go do that. But if you have a fiduciary obligation as a financial planner, but under the CPA arrangement, business, they're always constantly applying their risk, adverse to risk, typically to their clients. And these are clients that they bet it all the time. I mean, they wouldn't be successful if they didn't,
It's really backwards, the way that we're kind of pulled from both sides of the equation of, losing our license if we get too aggressive, but not representing the client appropriately. And, I'm huge in that fight with the AICPA and whatnot to move more towards value pricing, which is just one simple example of something that helps us represent the clients better. But yeah, there's a lot to unpack there for sure.
There is. And everybody's got their role to play, and I get it. I do. It's just but I think most business owners today are, they're looking for alternatives. And I think if you don't bring these types of tools to the table, you're going to lose them as clients from a CPA firms too. From that standpoint.
Yeah. Well, what I think you're getting at that I like to say is it's not the CPA's decision, in my humble opinion, as to whether the taxpayer does the strategy or not. It's the CPA's responsibility to bring the concepts to the client or the taxpayer and let them make that decision on their own. We can present, red light, green light, orange light. We can present best case scenario, worst case scenario. Let the taxpayer make that decision about themselves, right?
No, 100%, and 100%, and that's really all we can ask for, honestly. And that's not. That's good. That you're being a true consultant at that point, right? You're bringing value add on both sides. And if he wants, and we had CPAs to do that. Said, hey, this might be aggressive tax planning, but I think it's worth looking into because the client just got burnt on a claim that he thought he was going to have coverage, for example, and the accountants know that, right? Because they're dealing with that, right? In their tax returns, they're dealing with the loss, right? That, so those are all times when, again, for the right client, it's a hell of a tool.
For sure. Okay. So I want to kind of walk through that life cycle of forming, running, and ending, so to speak, a captive.
Yeah.
So I'm going to kind of give a case study and then you correct me as I go if I say something off or that's not clear. So let's say someone forms a captive today. So we're in 2025. There would be a C Corp formed. Your company would help manage the administrative things. And like you said, do the tax filing. And you'd help them decide what that premium is, what to insure, what the risks are involved for them, right? And let's say that they decide they're going to do the $100,000 a year to make it easy of a premium. So each year from here on out, how many years are we committing to this premium, so to speak? Is it like a 10-year minimum or is there more flexibility?
No, I would say it's year to year.
Okay.
And so these are 1-year policies that we're going to issue to your operating company utilizing those $100,000. So that's a reserve. And again, it's operating like an insurance company, right? So those are dollars at risk during that 12-month period. Policies expire, they become surplus if you have underwriting profit, assuming you didn't have claims yourself, or, one thing we do need to talk about and what got a lot of people in trouble was not having a distribution of risk, utilizing the law of large numbers. And again, we probably do that better than most, but as far as how we demonstrate that. But besides that, then they have an underwriting profit, policies expired. Now they reload another 100,000, let's say, or they say, hey, you know what? I don't have a tax liability. Hey, economy's slow. I'm getting hit. Hey, I wouldn't bought a piece. I don't have, maybe they don't fund that year, and that's perfectly fine. It's going to cost $6,000 to maintain the plan during that year that you don't fund, and that's really paid by the C Corp. And so that pays the tax returns, the domicile fees, our admin costs, and all that. So it becomes really, we designed it in a way that becomes during those ebbs and flows of the economy or whatever is going on in your business cycle, it's not killing you to own one of these things, which I witnessed that in 08. It got so darn expensive because it was a fixed fee every year, whether you funded risk into it or not. If you did it for tax purposes, it eroded very quickly. And so we didn't design our program that way. And so that's one thing. So, but as you build these up, the whole idea is to become surplus, and that's year to year, right? These are 1-year policies. Sometimes we do a trail policy, or let's say we have company, somebody sells their practice and they want a tail policy for errors and omissions or something like that. We'll build an 831B for that kind of transaction. But really it's designed to build up those surpluses. So down the year, 2 years from now, as you build up that surplus, say, hey, I want to take on a higher deductible. Not why, because I got money banked from, from previous profitable years. If something happens, I'm going to rely on those dollars. So why wouldn't I want to try to save as much premium as I can? And if it's not big enough, I wouldn't turn it in anyway, based on the current market we're in, because I'd be worried about losing my insurance program. So these are all things that we talk about, right, with business owners every year. So the whole purpose is to build those surpluses up. And, but it's not, I tell clients to look at least a 5-year runway. Minimum, if you're going to do this. That doesn't mean you have to contribute every year, but you're going to want to commit to at least over 5 years. And then you can decide, obviously, year to year. And, if you decide, hey, I'm going to shut this thing down because you sold your business, I would tell them, life issues, right? I mean, we have at least 10% of our clients every year decide to shut down, or their last year to fund, and we're going to shut it down next year. There's a $3,000 closing fee. It pays the final tax return. And we issue a 1099, in which, obviously, if the surplus, if all the dollars are in there, been in there 1 year, 1 day, you're going to end up paying capital gains on that as well. We also have other clients that will move it to a holding company. As soon as they do that and re-domicile it somewhere else other than our domicile, then we kind of step away from that because you're really not an insurance company anymore, and we
Sure.
know our lane. I should also mention that we don't manage the money. That's one thing that makes us unique as an administrator. We work with their financial planners, or the business owners could be self-directed. They're going to sign an insurance investment agreement, what they can and can't do with the surpluses and the reserves.
Okay.
But we don't manage that. And I think that's also been a big advantage for our clients and for us too in the marketplace, because we have a lot of financial advisors that refers clients, and their motivation is to manage more money, which
Yeah,
what we
exactly.
get. So
Okay, cool. Okay, so let's say that someone's in the highest personal, well, we're not doing, yeah, no, we would be doing a C Corp deduction, which would be 21%, right?
well,
For,
that's a corporate taxes, and then you'd be, on the capital gains side. And we have a pro forma, by the way, too, Jackie, that we kind of send out to clients and says, hey, put your own numbers in. We don't do a pro forma for you, but here's the Excel spreadsheet. But it's all dressed up, of course, but it puts in how much premium you want to contribute, what's your loss ratios, what's my investment rate of return. If I did your program net of all fees, what's that look like over 5 years versus just trying to use after-tax money? And do I win or lose on that? Just do the tax arbitrage
okay,
from
cool.
ordinary income rates to capital gains or long-term dividend rates. And so,
Right. Okay. So what I was just trying to say, which I said completely wrong, is that you've got the business entity that is contributing the premiums, which is going to probably be a pass through. So that would be the personal tax rate plus state tax rate. So someone could be 37% plus, 11% California, almost 50% tax rate on
yeah,
the personal side, right? So we're contributing that 100K premium, getting almost 50K a year in tax savings for the contribution. The C Corp insurance company is not recognizing that as taxable income because it's not it's tax exempt income. Now, it's when I was kind of analyzing the situation of like how this plays out, obviously no one wants a bad adverse event to happen, but the best tax benefit happens when the adverse event does happen, right? Because they get the proceeds and then it's not taxable back to them. Is that correct?
yeah, it depends on how it comes. Well, and here's the thing: it's about being made whole, right? So, I mean, that's the insurance term, right? So, if the claim's legitimate, we go through adjudication. That's again, as we administrator make sure all that happens. The client has a claim; it's legitimate. It's covered under one of the policies. We push that money back over to them. But here's the thing, right? They're not going to be able to take the expenses now, right? So they've been made whole. So there's a way that you'll take the expenses, but you add you know what I mean? So you guys know that. You guys can speak to that better than I can as a CPA, but so it's kind of balances itself out. And the idea is that, hey, I didn't erode my cash flow, right? So if I didn't have that infusion of cash come back into my company, my cash flow would have took the hit, right? So that's keeping everybody whole and keeping everybody open, and that's kind of the way it works. And also, I would tell you too, and you bring up a great point. I don't know where capital gains and dividends goes down the road, right? That ball gets kicked around all the time. I will tell you that right now, our clients win on that net of our fees over a 5-year, in the tune of depending on the amount of premium, because there are different break points and all that stuff, but minimum is going to save you about 15% and as high as 30% over those 5 years. So if you just want to look at the tax arbitrage of it, and honestly, we hope our clients win on that, but we don't know where that sits 5 years from now, obviously.
Yeah. Okay. So yeah, you kind of hinted at this, but let's say you don't ever need to exercise that policy or whatever you call that, and you end up selling your company, you don't need this anymore. And so on the back end, like you said, it does convert from an ordinary deduction that the business got up front to capital gain income on the back end, right? So there is a little bit of arbitrage there as well.
Yeah, and the other thing too is, and this is where we want to work with firms like yours, because honestly, we'll allow you to keep it open for 3 years after your business has been closed. And most it's going to cost you $6,000 a year. Well, is your tax rates on your capital gains and dividend rates are tied to your income level brackets. For example, if you hit the highest taxable income bracket, you're going to pay another additional 5% over and above on your capital gains or dividend rates. You're going to go from 15 to 20%, right? So these are where folks can step in and do some more strategies on the back end. Is how do you want to have this money get pulled out over a period of time? And these are just strategies. We don't advise the client on those, but we just see what their advisors have done with them over the years, doing this for as long as we have, where there's some really smart things to do on the strategy on the back room on these things and how you're going to deal with those surplus and reserves. And then a lot of times business owners end up, they can't help themselves. They just buy another business, and so
Sure.
we just keep it going. But, and we'll do some things like if they're going to have to hold a note, we may do some stuff on that where if they're holding a note, we may add some additional policies in there. If they're repping warranties in there, if the seller of the business, because they represented it or warranted some certain things that when they did the selling and then of course, and then there's always disputes, unfortunately, between owners and buyers that, something didn't go along with the contract. So there's a safety net there too that we can build in. So if they do need a call dry powder or rainy day fund, war check, whatever you want to call that, basically it's sitting there in the event of. And I would tell you, we run into that quite often.
Okay.
We actually help sales come through because a lot of new buyers aren't, they're worried about the warranties that they, especially if you're a service driven business where you've given out a lot of warranties over the last couple of years. And now that the new buyer's got to honor that, he's going to try to devalue your business, where we can set the 831B up, fund it, even with some of the sale, the proceeds from the sale, and fund that up. So if something happens, that's the dollars they're going to work with, so they don't get the devaluation of their business. So there's some lot of different strategies to consider.
Mm-hmm.
And we work with a lot of merger and acquisition firms around the country. And
Okay.
I will tell you that we can really help the sale go through sometimes just based on that structure alone, where the buyer's a little bit more at ease of buying them and honoring those warranties. Because a lot of times you're buying them because of your brand, your reputation, your consumer confidence. That's what drives your value of your business.
Sure.
That's what you're selling. That's what they're buying. Now, how do they protect that? And that's utilizing a program like this.
Okay, cool. So I think the only other question that I think a lot of people ask that I haven't asked you yet is, what exactly are we insuring, right? So let's say it's an accounting firm owner that is putting in these premiums. Can you insure their mental capacity because it's all about their brain, so to speak? Or I've heard of people insuring their legs when they're a runner, or all these unique things.
No,
So
I would say one of the things we've done is gone out and done key employee insurance. And what we've done in a heck of a lot different way. If you're a rainmaker for your company, or even if you're an owner of the company and you're a rainmaker, we deal with a lot of times with surgeons. They're high performing, high revenue, and a very specific, you might be supporting 100 different employees in that firm, but if you don't go out and sell, or you don't do that procedure, you don't do that, none of that money trickles down to the other employees, because why? You're the rainmaker of the firm. Mm-hmm. We'll insure against those types of things, because here's what we're insuring for though. What happens if, and we've had this happen, what happens if that surgeon has cancer?
Sure.
They might have disability policy for themselves, but the business is going to have a huge business interruption, trigger an event. Mm-hmm. And a lot of times people don't really know where to turn with those. Or if you had a top salesperson and they, with a ton of relationships that was driving a ton of revenue, and he gets in an auto accident, or, you might have work comp and all that stuff for him, but what's happening to the business? And so that's how we apply those risks. We're seeing it in a lot of different ways right now. Especially, you can buy key life insurance, but what if the person, what if they're going to come back to work 6 months from now, but they're in those 6 months, what did you do? Mm-hmm. Either had to hire more people, pay higher commission, whatever you had to do what business owners do, survive. And when those unexpected things happen. And honestly, I would tell you this, the more you're dependent on those types of individuals in your firm, the more risk you have.
For sure.
It's one thing if they leave. Now, here's the difference between this and business risk. If they go down the road and you didn't have a non-compete and they went to work for a competitor because they got paid more money, that's straight up business risk. But if they got hurt during a skiing accident and they just simply can't come to work anymore, or they're not able to work, or God forbid, if they did lose or, whatever, or become mm-hmm. disabled, or whatever happens in the world of life, mm-hmm. That's a big hit to the business. And that's just one aspect of what we look at, honestly. Mm-hmm. And we ask the questions of the business owners. Like I said, if you've been in business long enough, we ask them, what's keeping you up at night? And exactly. Unfortunately, we all have stories. What are we worried about? What do we feel like we're not completely covered for, or we're worried if we were covered, are we going to get everything we need to really make ourselves whole? And I would say that we sit and listen to the business owners, and they'll tell us what concerns them mostly, and then from there we'll build a program around that, or we'll make recommendations to them as well, obviously. So
yeah, awesome. Okay, that's great. All right, well, as we close up, I know you've been on a lot of podcasts, you've spoken at kind of countless conferences. What would you say is one key takeaway that you hope listeners always kind of walk away with after you speak or are a guest somewhere?
I think the thing I try to hit home on, because I'm an employer as well, is don't be so quick to discount something without really truly educating yourself on it and doing your own due diligence, and sit back and really analyze it. I think we as business owners, entrepreneurs, want to go out there and beat our chest and run up the mountain as fast as possible, but and then we're quick to make decisions, which I'm one of those guys. But I've come to realize that I owe it not only to the risks I've taken to get where I'm at, but also for the employees that I'm helping to self support, and they're helping me support myself. All the things that I've done up to this point, I call it, business owners typically have a short-term memory. We almost have to, or I make a joke, but we'd probably all be in a fetal position laying in bed still if we remembered everything that went wrong over the last several years, right?
Childbirth, right? Like you just conveniently forget it all.
Yeah, exactly. You got to have short-term memory, or you would never do it again.
Right.
But in these situations, I think it's one of those things where you got to work on it, not in it, and that's really what I try to drive home for business. And it's not a silver bullet. It's a great tool, but and you owe it to yourself and the people that you help support, honestly, and support you, to look at all these tools that are available to you, not just this one, but all, to your point earlier, about all the different tax incentives out there and what works best for you.
For sure. Okay, great advice. Now, for those that do want to reach out or have more questions or would like a consult, what is the best way to get a hold of your team?
Yeah, so 831b.com is our website, and mine is van at 831b.com, so it's VAN at 831b.com, and hopefully everybody can remember the 831b after we've had this conversation. But no, I think that's a great, and always go to our website. I think there's a lot of we design our website to be more of an educational process, because that's really where we're at. I mean, we educate, and eventually the right client says, hey, yeah, I want to go with you guys. So it's educate first, and we design our website to really kind of go through that. We've got a lot of good case studies on there, and we're always more than willing to work with the client themselves or their own trusted advisors as well, their CPAs or whoever, to really get them to understand whether or not this is a tool they want to use.
Awesome. Thank you so much for your time today, Van. It was really, really helpful. We have a lot more resources and information within Tax Plan IQ as well. They are one of our preferred vendors, which is always great. So on that note, we're going to close for today. Thanks for everyone's time, and hoping you a wonderful rest of your day. Take care.